Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about EQ Bank stock. Andrew Moor, the CEO of Equitable Bank, recently spoke at the Scotia's Bank 25th Annual Financial Summit, and he was asked a lot of questions and he provided interesting perspectives on EQ Bank balance sheet, their capital situation, their recent acquisitions, and finally their future growth. I will include 5 short clips of Andrew Moor interview in this video and provide my commentary on his perspectives. I will also discuss why I remain extremely bullish on EQ Bank stock even though the stock sits at an all-time high share price right now. A disclaimer, EQ Bank is one of my largest holdings in my stocks portfolio at the moment, as I own 200 shares of EQ Bank, almost $20,000 worth of this company, inside my tax-free saving account. We have a lot to cover in this video, so let's jump right into it. EQ Bank is Canada's 7th largest bank, and it has a very strong balance sheet, profitability matrix, and growth matrix for a financial institution. EQ Bank has an amazing track record of growing various aspects of their business, including the total amount of the loans under their management, the number of customers, their EPS, book value, net interest margin. All these metrics basically consistently year after year. Their return on equity is around 16%, exactly at 15.9% at the moment, which is great. Their net interest margin is at 2.09%, and it is expanding, which means their profitability is increasing over years. Finally, they are trading at 1.25 times of their book value, which is a bit higher than their historical average, but even that is not expensive valuation for a fast-growing bank like EQ Bank, and it is significantly lower than the other 6 banks in Canada. On top of this explosive growth, they also have one of the fast dividend grower companies in Canada, with a dividend increase every single quarter with a CAGR rate of 22% year over year in the last couple of years. Overall, I think EQ Bank is a great and well-run business, and that's why I continue to invest in this company. Andrew Moor, the CEO of EQ Bank, who is by the way the CEO of the company for almost 15 years now, recently spoke at Scotia's Bank 25th Annual Financial Summit. I will leave a link to full speech in the description box of the video, but let's look at a few short clips of his interview after the presentation and his answers to the interesting questions of the interviewer. The first question was about EQ Bank return on equity. As I mentioned, EQ Bank was able to have a great profitability matrix, and one of the most important metrics for a bank is the return on equity. Return on equity is a financial ratio that shows how well a company is managing the capital that shareholders have invested in the company. EQ Bank return on equity, or ROE, is at 15.9% at the moment, which is one of the highest among the banks in Canada. For the reference, Scotiabank ROE is around 10.5%, and Royal Bank ROE is at 14.5%. The first question was how EQ Bank was able to maintain such a high ROE despite increasing their loan loss provisions.
Through results, 16%, basically 16% ROE, despite, if I look at it on a sequential basis, flat sequential growth, some margin contraction sequentially, still rising provisions in your equipment finance portfolio. Seems pretty remarkable to be able to deliver that kind of ROE in an environment that's still not, there are definitely still some challenges there that you're clearly earning through. So the question is, how are you able to do that, and give us a sense in terms of the engine behind to this?
Yeah, I think the margin compression is some more a feature of, frankly, different quarters, different length of number of days in the quarter really drove that. So I'd say margins were flat. Certainly, as part of the success we've had as we move transitioning to more fee-based income is certainly really helping. So the securitization income, some of the fee-based revenue we're getting from ACM Advisors, which we only bought towards the end of last year, and some other things we bought with Concentra Trust, driving that sort of fee income, which has also been part of a strategic pivot. So I think it's managing our costs tightly, obviously, and driving good businesses is really what's driving that ROE.
So he basically mentioned that they did this mainly due to their transition to more fee-based revenue and fee-based income, which was one of the main strategies of EQ Bank in the past couple of years. They tried to invest money into streams and services that can generate high returns compared to the conventional banks, and that's why they were able to achieve such a high ROE for a bank. Next, Andrew Moor was asked a question about their excess capital and how they want to manage this capital.
To talk about capital It's an advantage of slower growth, I think, if we can call it that. I mean, you're definitely accreting a lot of capital, 14.7% CET1 ratio, as you showed, up 60 basis points quarter over quarter, and likely to expand further from here. So that leaves you in a good position. It's a good problem to have a lot of excess capital, and the question is, what do you do with it? What are your capital deployment priorities between, buybacks, dividend increases, M&A,
Right.
obviously organic growth? So how do you think about sort of ordering those priorities, and how do you think about this?
Yeah, so I mean, there's a lot of different options with capital. I mean, we think we should be operating CET1 in a sort of 13 to 14% range, 13.5% sort of being the midpoint of that. So we've definitely got excess capital, excess common equity capital. You've seen that recently we launched an LRCN, so we're trying to have a more sophisticated capital structure, and over time, you'll probably hear us talking more about our total capital ratio than you will about CET1. Historically, we've always talked a lot about having a very simple capital structure with CET1 able to absorb losses. In terms of priorities, the first priority, frankly, is to find other investments that we can make that generate our hurdle rates of return that align with our challenger bank attitude. So things that bring value to Canadian consumers and deliver these returns on equity, and kind of where we can get our staff and team excited about the value we're bringing to Canada through this kind of challenger bank attitude. So that is the first approach. Much of it is really reinvesting in our business, reinvesting in loan growth, and also finding new services that we can offer, whether it's better services in EQ Bank. We're just going to be launching our small business banking option on September the 11th, I think, this year. So there's the things we're constantly rolling out and having to invest and wanting to invest in. We've just come off a period where we made a commitment 5 years ago that we were going to increase our dividend by 20 to 25% CAGR over the 5-year period. We just kind of job done in the last quarter. We just achieved that. So we're in a process right now of certainly about listening to investors to sort of see what investors think is the right way for us to go. That's going to help inform our decision. I suspect going forward we will continue to have an increasing dividend, but still a lower payout ratio from the other banks, because we do believe we've got significant growth opportunities ahead. And while we have a NCIB that we're able to use, we haven't actually used it for our common equity to buy back shares. But I think it's certainly a tool in the toolbox. We want to think carefully about when and how we would use that as another way of deploying capital. So there's a few alternatives. I would say we're in kind of a bit of a process now as we come through to our year round, and we're sort of thinking about year-end planning for next year. We're actually sort of really open to some conversations. And interestingly, the only comments I've had back from shareholders today is keep your dividend relatively low and do what you're doing, i.e. find high ROE businesses that you can continue to grow and invest in. So I'd be particularly interested in somebody who has a different view than that, because with the only view I've heard so far is that view, which kind of aligns with where we've been historically, and so it sort of makes sense to us.
Here, Andrew Moor basically mentioned that EQ Bank has excess capital and their capital ratios are pretty good. EQ Bank's CET1 ratio at the moment is 14.7%, which is way above the required number by central bank. They want to use their excess capital to invest in businesses and find new ways to invest and receive higher returns for shareholders. He also mentioned reinvesting money into their own business and offer new services and products. They're also going to increase their dividend, and now they are thinking about even buying back the shares of the company if the majority of the shareholders and management team agrees on the value here. All in all, it seems finding good ROE businesses is top priority for EQ Bank management team, which is great. But they also think about ways to return more of this profit to the shareholders. Next, he was asked a question about their future plans for expanding the business and whether they prefer to build something or buy another company and integrate it into the EQ Bank platform.
So in terms of that build versus buy, I mean, your preference is to build, but if you don't have the capabilities in-house,
I think that's right. And so just your point on things that we probably most focused on would be a wealth offering. With the largest bank in the country, you could argue ACM is a wealth offering, but I think certainly we have 450,000 customers in our digital platform that we know from customer research they are open to a wealth offering from us. So would there be something we can do in wealth? I think that's a really interesting opportunity. Payments as well is an area that we involved with. We have payments infrastructure that we provide to others, but there may well be other payments businesses that we could add to supplement to our capabilities, and that would probably be a buy rather than a build.
He mentioned that EQ Bank's main focus is on building infrastructure in-house in terms of the most important product or services, and Moor seems to be more focused on wealth products that they can offer to EQ Bank customers, things like investment accounts and retirement services. And also he mentioned payment services, potentially something like credit cards. Next, Andrew Moor was asked about multifamily building mortgages and the risks, which is an interesting question as I personally also hold a residential real estate investment trust called Kilam Apartment REIT in my portfolio.
In terms of the strength that you're seeing on the multifamily side, we're hearing the government scale back immigration targets, and that conversation is moving in the opposite direction of where it has for a long time. Do you see any risks to the multifamily story, or is that pretty well on a pretty good growth trajectory in your view?
Certainly, it seems to be on a pretty good growth trajectory, and frankly, we've got behind, right? We've got to do catch up here to build enough housing units for the number of people that have come into the country and want to form households here in Canada. People living in substandard housing, and we've got a lot of building that needs to be done before we'd ever be talking about problems the other way. And I think what'll be interesting is over a sort of 5 or 10 year period, what is the national sort of consensus on immigration? Have we changed this fundamentally? I don't really believe we have. I mean, fundamentally, Canada is a country that's open to immigration. It's just, I think, over the last 2 or 3 years, possibly we let it get a bit out of control, and that's caused a bit of a pushback. But I would have thought over the longer time period, we're still going to be a country where we've got, above normal population growth for the G7 as we continue to welcome people from around the world into what's one of the world's sort of good democracies for sure.
He seems to be super optimistic about the future of multifamily business mortgages as we have low supply compared to the immigration and new families coming to Canada. He also mentions that we should see how immigration policies will change in the future, but he expects a consistent growth in the future. Last question is about the acquisition of ACM, which happened last year. And basically, the interviewer asks why they went forward with this acquisition. I
want to ask about ACM. You referenced it a few times. You acquired it last December. Can you remind us why you decided to acquire it and how it fits in with the bigger strategy that you're set for the company?
Yeah, so these are assets that are adjacent to what we do. Many of the same customers of ACM would also be customers of ours. So we might be lending to a client on a construction loan, for example, where a cash flowing loan from the same client sits within the same within an ACM portfolio. ACM, the funding comes from pension plans, institutional investors that want exposure to commercial mortgages. For us, it's part of that diversifying into fee-based revenue, while at the same time working into something that's very familiar to us, many common customers, opportunities to cooperate where potentially there's a mortgage that we can, or we've got a customer that ACM may not know, where we can provide a referral. Clearly, they need to be operating in a way that's fiscally, they've got prudential responsibility to their own client base. There's many things we can do to cooperate and help each other through the piece.
He basically saw good synergy between ACM and potential services EQ Bank can offer to their customer, and it was a good strategy to diversify their sources of income to more fee-based income. Overall, these were all interesting points that Andrew Moor raised during his interview, and when I was listening to this interview, I thought it could be a good idea to make this summary video here based on the interview and share it with you guys. As I mentioned in the start of the video, I remain bullish on EQ Bank as I believe EQ Bank stock has overall a conservative balance sheet with enough liquidity. They have a great management team which is focused on value creation for shareholders, and they have lots of growth avenues. Big six banks in Canada cannot take much market share from EQ Bank, as EQ Bank is pretty small in size compared to the big six, but EQ Bank can definitely take market share from big six banks here in Canada, and they already started this super growth cycle. I hope you enjoyed the video, and if you enjoyed the video, you're interested to follow contents related to EQ Bank and other Canadian companies, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.